What is going on, everybody? Welcome back to another episode of That Makes Zero Sense, the podcast. I'm your host, Alex Ivanovich. Nothing has changed there. On today's episode, we're going to do similar to what we've done in the past. I took a lot of questions in from listeners this week. I chose the 5 best questions. I wrote them down in my notebook. We're going to address them in today's episode. So without further ado, let's jump right on into it. So, question number 1 says, with the Iranian war largely behind us, why is oil still so elevated? Stocks are marching higher with no issues. The TLT also looks good this week, with rates down on the week. And then in brackets, it says, I'm sending this question in on Wednesday. Things are obviously subject to change. Yes, you are correct, listener/viewer. Things are always subject to change. If you're sending that in on Wednesday, who knows? But it does feel like watching this market break through a new high every single day that there's not going to be any change, and we're just going to continue to float on higher until something breaks. I do want to pick apart that question a little bit. The first thing you said, with the Iranian war largely behind us, I put an asterisk on that because I don't think it is largely behind us at all. There's been no legitimate ceasefire. I mean, we're in this 2-week ceasefire, and obviously there's these meetings taking part in Pakistan, and there hasn't been any severe bombing. It kind of feels like Israel has toned down its bombing in Lebanon, and all these groups surrounding the Middle East region haven't seen any bombing from Iran. So yes, things have cooled off. I would say that's probably a better way of putting it, but I would not by any means say that this war is largely behind us. I think there's a lot of risk still. Things could go wrong. You never know. Just based on the last few weeks, with what we've seen regarding headlines, every day there seemed to be something new and contradictory. One side would say one thing, the other side would say a completely different thing. And so there's still a lot of risk. I'm not going to trust that this is over until the Strait of Hormuz is completely opened and we go back to vessels traveling the strait. The volume of vessels, I should say, traveling the strait goes back to normal levels. So that's my first comment on the question. Now, the second part of the question, why is the price of oil still elevated? So we talked about this a few episodes ago, I think. Let's say, for conversation's sake, Iran and the US and Israel came to a definitive agreement and said, okay, we're going to stop the war completely. There's not going to be any more bombing. We've come to a full-on ceasefire. This is completely behind us, and the strait will open completely. Obviously, I think in that case, you would see oil have this precipitous drop. Probably, if I had to guess, if you're looking at the USO, it'd probably break 100, maybe trade around 100. I think it's 120, 130. But I think this also speaks to why oil is still so elevated. There's still risk in the region. There is still risk premium built into the price of oil. And even if things do improve substantially in this sort of scenario, the made up scenario that I just mentioned, you'd still have oil prices elevated in that case because we just had a hot war in that region. And so for, I don't want to say months, but for at least a month after, you're going to have this sort of risk premium priced into the price of oil. Now, if you're wondering what risk premium means, when you talk about risk premium in the context of bonds, for example, you have government treasuries, which are the safest bonds, and let's say for conversation's sake, they pay 4%. But let's say your standard 10-year bond pays 4%. Now, investment grade corporate bonds are a little bit riskier. They're going to pay a little bit more, let's say roughly 6% or 5%. So 1% more. So there's a spread of 1% between what is essentially the risk-free rate and a slightly riskier bond. That 1% spread is sort of the risk premium, the premium that investors are demanding they get paid for taking on an additional unit of risk by going out into a more riskier product. Now, if you go one step further and you take a look at junk bonds, junk might pay 7 or 8% because that is one step further out on the risk curve. And so investors are demanding a 2 to 3% spread. So in the context of bonds, that is sort of what a risk premium means. Now, when you look at oil, let's say oil largely for the last year and change has traded between $40 and $60, let's say the USO. Because there has been a war happening in the Middle East, that is a risky event that could potentially take a lot of oil offline and significantly constrict the supply of oil. When you restrict the supply of any good, the laws of supply and demand would say the price of that good is going to go higher if demand holds constant. So anyway, the war has sort of created this risk premium to show up in oil. And even after a war ends, there might still be a little bit of risk premium priced into oil because the war only just ended and there's still risk of something flaring back up in the months afterwards. That's what I mean when I say risk premium. That's sort of why there is still this elevated price of oil, is because I don't think we're completely out of the woods yet on what's going on in the Middle East. It was probably a bit of a long-winded answer for such a simple question. So let's move on to question number 2. I want to improve the sources of information I use. I think I consume a lot of a lot of garbage. Can you recommend some good podcasts or something where people offer opinion like you do? Well, there's a lot of places you can get opinion. Instagram has got a lot of people with opinions. TikTok has got a lot of people with opinions. There's no shortage of opinion out there. And there's tons of podcasts. There are tons of, especially finance pods, stuff like that. If you want to watch something good, you asked specifically about podcasts, but before I get to podcasts, I want to say if you want to look for good opinion pieces, there's good op-ed pieces in the Wall Street Journal. There's, I think, Barron's. There's not really an op-ed section in Barron's, I don't think, but Barron's does have these analysts that post really in-depth analysis, good stuff that I like to read every now and then, bearish and bullish reports. And I don't think subscription to these services is that expensive. And if you're looking for really high quality opinions, I think those are good places to start. Now, if you're looking for opinions through a podcast, I know this guy who sits in this office with some nice pictures and books behind him, and he kind of looks disheveled some days. He has this podcast that's called That Makes Zero Sense. I'm just kidding. That's a great place to start. I'm just, it's a little shameless self promo there. It's a great place to start. But the All In podcast, I think, has good data every now and then. I would be weary though. Their opinions, I think, are a little biased given their involvement with the government. Certain members of that podcast are very entrenched and very deeply involved with the Republican government that's currently in power. But I think the data and actual points that they make are pretty strong. And for just strictly from a knowledge standpoint, I think they're pretty good to listen to. But I would be weary of some of the opinions, especially when they get into politics. Brad Gerstner, I'm forgetting the name of his podcast. I think B2G or BG2 or something like that. Brad Gerstner and Bill Gurley have a good one that's pretty non-political, and they talk a lot about tech. That's another really good one they like to listen to. And then there's a lot of, if you're not really into markets, or maybe you're not at that level yet where you can fully understand and take in what these people are saying. Because I understand the B2G, the Brad Gerstner and Bill Gurley one, the all-in one, they use a lot of technical language, and I understand that can be really intimidating and difficult to consume if you're just getting into this. There are a lot of podcasts on Spotify. If you look at the top 10 on Spotify or on Apple Music, if you look at the top 10 finance and money podcasts, there are a lot for beginners who are just getting into this, who want to understand the market. There are some really good ones, and I implore you to go and explore them. The two that I just mentioned are ones that I listen to because I like to learn about tech, and they talk specifically about AI and the markets and things that I'm involved with every day. So from a idea and information standpoint, those are ones that I like. But by all means, explore. There's tons of good ones out there, and maybe you want to watch mine a little more often, right? So let's move on to question number 3. Do you have any other reason to not be long AI? Sort of feels to me you constantly talk valuation, but Anthropic and OpenAI are crushing it. Yeah, okay. Is there any other reason not to be long AI? Well, maybe let me give a little bit of an outside of the box answer here. We've talked on this podcast in great detail about how the valuations are crazy by any metric. The spending and no promise of ROI is scary. The fact that none of these AI companies are really profitable yet and are still burning through a lot of monies is concerning. These are all the normal arguments that I think are very fair arguments, but these are the normal arguments you hear, and I don't think that those are the arguments that this listener, when they submitted their question, wanted to hear. They wanted something outside the box, so let me attempt to give you something outside the box. I'm going to use an example here. When a drug comes to market, let's use Ozempic as an example. When Ozempic first not came to market, but when they were going through trials and they were testing the drug to make sure it was safe for humans. The reason that the FDA exists is to protect consumers from potentially harmful drugs and to make sure consumers are well informed of all the risks that are involved with any drug that comes to market. They ensure that companies disclose any side effects, any anything that could really happen when you take any drug that they recommend. So when Ozempic was going through all the trials and there were any side effects, they had to make sure that they disclosed it. FDA made them do that. And then obviously Ozempic went to market and performed really well and tons of people got on the drug. But that only happens because they went through the FDA process for any food or drug. They're called the Food and Drug Administration for a reason. Now, when I look at AI, you could sort of comp AI to that idea of it's potentially harmful for constituents in America. Now, what do I mean by that? So, Ozempic, although it does these great things for weight loss and curbing your appetite, there are many side effects. When AI comes to market, it seems like a great software tool. But when you start to think of it in the context of it could potentially replace an entire workforce and automate a lot of entry level jobs, that is a huge concern if I am sitting in federal government on either side of the aisle, blue or red. I think a major risk to AI that's not being talked about enough is that you could see something come out of government that acts sort of like an FDA for artificial intelligence products. If you think for 1 second that the federal government is going to allow unemployment to go from 3% or whatever it is now to 7, 8, 9, maybe even double digits because of AI, you are sadly mistaken. If we got to double digit unemployment, you would see this market absolutely implode. And if there's anything that we've learned from the war in Iran, is that everyone in the world knows the US government's pain point is what does the stock market do? So I think a major risk to AI and a reason for not being long AI or completely exposed on the long side to AI is that there is this huge regulatory overhang. And I mentioned last week that if we get to the midterm election, and there is a blue wave. The Democrats do a clean sweep and clean house, and the Republicans no longer effectively have control. You could really start to see some red tape come out with regards to regulation to AI. And I think if you start to see that happen, these valuations maybe don't get cut in half, but they really need to come down and get checked. So, long story short, you could have this system get put in place that is sort of a FDA governing body, but not for food and drugs, but for AI. And to make sure that, hey, before you release a model, what percentage of the workforce is it going to disrupt? If it's going to disrupt, 20% of one industry, we're going to have to scale that back and not allow you to release that. I hate to say it because I love free market principles and I like working with AI. It does make my life easier in some respects. But like I said, if you think for 1 second that the government is just going to allow the unemployment rate to balloon as a result of AI, you're sadly mistaken. And I think there is a legitimate regulatory risk that is not being priced in with AI right now, especially with where you see these valuations. So maybe that's a slightly outside of the box answer. Hopefully, I articulated that properly. So, question number 4 says, I noticed when Amazon announced buying Global Star, the transaction price was quoted to be $90, but GSAT still trades at 80. Why is that? Should it not be $90? Okay, so I know what you're thinking. You probably look at GSAT right now, it's 80 bucks. And if you know Amazon's going to take it out at 90, there's a $10 spread there. So if you buy GSAT today at 80, you can make 10 bucks for free, basically. Well, it's not for free. There's a reason why there's that discount. There's a reason for that discount. First of all, the deal is not supposed to take place until 2027. So roughly 18 months, that's about a year and a half. And it's a 12% from 90 to 80, $10 spread. It's about a 12% spread. So if you bought stock at 80, your annualized return is about 8%. I think just above 8%, which is a sort of blah return for a year for something that's got a lot of risk involved. I think the second biggest thing is that Apple is a large shareholder in Global Star and are deeply entrenched because I think they got Global Star to help them build out the SOS and satellite service that is currently in the iPhones. So there's a little bit of, where does Apple play into all of this? And I think the final thing, which is the most obvious thing, is that the FTC or FCC might block the transaction because they deem it to be anti-competitive. There might be an antitrust block, and then Amazon can't buy Global Star whatsoever. And then you see Global Star fall from 80 to wherever it was before, 70 or 60. And then you have a legitimate loser on your hands if you bought stock at 80 and you're waiting to get taken out at 90 by the Amazon transaction in 2027. So there's a lot of risks still involved, and that's why there's always a discount to the deal price before a transaction is actually closed, is because there's always a risk that a deal doesn't happen. And that's why you have all of these M&A arbitrage funds who do this for a living and are very sophisticated at it and have a lot of knowledge in doing it. But it is sort of this arb trade. If you could say with a lot of certainty and you were very close to Amazon, or maybe you were a big shareholder in Amazon and you were a big shareholder in Global Star and you knew the business really well and you had a couple buddies on the FTC and you sort of understood the landscape on which this deal is going to take place. I'm just saying that from the perspective of someone who might have a lot more knowledge than we do about the transaction and the landscape of the transaction. So hopefully that answers the question on why Global Star is trading at $80 and not at the deal price of 90. All right, so let's move on to the final question. Question number 5. The market acted this week like it was time to party, but you are still so negative and bearish. Why do you ignore good price action? I'm not going to rehash all the reasons. I feel like in the last few weeks, last few episodes, in my daily shorts, I constantly talk about the reasons why I'm negative, why I'm bearish, why I don't think AI is all that it's hyped up to be, why I don't think the S&P and the Qs deserve to be where they are. I've said all the reasons, I've talked it to death, but there's something at the end of that question. Why do you ignore good price action? It's not that I ignore good price action. I think the price action of the last few days is very telling of a market that's very strong and wants to squeeze higher. I mean, you have 3 really strong closes. It's not a tape that I want to be short right now because it could continue to trade higher. But I think when you're trading and when you're investing, it would be silly to have a one-dimensional approach and to only pay attention to price action. Because especially in today's world where now you don't even need $25,000 in your account to be a day trader, you can do it with any amount as of the most recent SEC headline. I'm going to quote Stanley Druckenmiller. He said in an interview a long, long time ago, but I just saw it on a YouTube video when I was looking at, Stanley Druckenmiller gives a speech or whatever it was that I searched up. I love Stan and I love watching his stuff. And whenever he speaks, I do listen. But Stanley Druckenmiller said in an interview in the 1970s and 80s, after a stock reported, if they gapped down on the report and then closed out on highs on a Friday, on Monday morning, you could bet with 90% certainty that that stock was going to open much higher on Monday. But today, that is not the case. And that is exactly what he said in that interview. And the reason is because there's now algorithmic trading. There is way more passive trading, meaning ETFs are buying and selling stocks in way more volume than they ever did at any other point in history. You have a way larger influence of retail traders who have a lot more money to transact in this market. And they are actually now a legitimate force, as we saw in GameStop, as we saw in AMC and many other stocks. Allbirds today was the latest example. Allbirds is now switching from a shoe company to cloud computing something or other. They're changing their name. And that's just silly to me. Allbirds had like a crazy short interest and was up 400% today. I think it was a $2 stock. And then I saw it at $10 at some point today. I don't know the exact numbers, but it was something insane like that. And that's something that retail is going to chase. That's what retail does. And so basically the point that I'm trying to make is, yes, you have to trust price action, but you have to do it with nuance and with a little bit of skill. You have to take price action with fundamentals and with flows and understanding how ETFs work, and understanding is a really good company getting sold because of some silly news. The markets are anything but efficient. And if you were to say to me, why don't you trust good price action? You're essentially telling me that the market can price all information perfectly all the time, which we've seen time and time again is absolutely not true. Just not how things work. And so that's why you can't trust good price action all the time. Price action is a very good tool to use in trading, especially I think in the short term. I use it every single day. It's a very important part of my life. It's something I pay attention to every single day. But for somebody to say to me, why don't you trust good price action? And that be the only thing that is supporting their thesis to buy the cues at a level where I think there's elevated risk and the valuation does not make sense given the elevated risk, and you're not taking into account all the other things going on in the world, I don't think that's an intelligent way to view the market. There's always nuance with these things, and you have to take a more dynamic approach than just being blinders on and saying, why don't you trust good price action? I don't mean to come for your throat when you say that to me in your question. I'm just trying to give you an idea of the way that I come to decisions and the way that I view things when I'm trying to piece together this beautiful puzzle that is the market. So I probably sounded a little bit like Kamala Harris there, but a little bit of word salad, a lot of stuff just jumbling together. Um, but I think that's a great episode, and I'm going to finish it up there. Thank you so much for listening. This has been another great episode of That Makes Zero Sense. Be sure to follow us on the TikTok, on the YouTube, and on the Instagram. I'm posting shorts there all the time. I hope you have a fantastic Friday and an even better weekend. Take care, manage your risk, and I'll see you next week. The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast.